So without further ado, I would like to introduce our founder and CEO, Don Wenner.
Thank you. Evening, everybody. So as Larry said, they're going to start bringing dinner out here in just a minute. I'm going to ask you to do a little bit of work before you start eating for a few of you. So first, DLP employees, can you do me a favor and stand up? So just so you see, at the end of the dinner, I'll be walking around answering questions after we do an open Q&A, but there's lots of other experts here in the room, a lot of our leaders in the room, so make sure you get a chance to chat with some of them tonight, and I'll introduce some of them as we go tonight. And you guys can sit down. And now, existing DLP investors, if you're currently invested with us, can you please stand up? So at most of the tables, there's some existing investors here. So these are people, you got to come up front, I guess, to talk to some existing investors here. But we got a bunch of existing investors, so they have their money invested with us. Great people to talk to and get their perspective if you get the moment here tonight. On their name tags, it does say active on their names. Means they're an active investor with us as well. So without further ado, I'm going to get started. As Larry said, eat as we talk. Feel free to get up and grab a drink as we talk. We'll open it up to questions at the end. My goal is just to give you information tonight, tell you a little bit more about us, what we do, how it works, why you should be interested. And then from there, if there's interest, we'll give you an ability to follow up, and we'll schedule a meeting with you and talk with you one-on-one. We don't expect anybody to pull out a checkbook tonight. We don't take any commitments tonight. It's just an opportunity to give you information and get to know each other a little bit. So we look at in the world of investing that there's two keys to investing. Number one is the manager. So it's the person you're entrusting your money to. And number two is the strategy. So if I was the best manager in the world, but I told you I was going to go out and go into the blockbuster and Hollywood video business as my strategy, I could be the best manager in the world, but it wouldn't matter if I didn't have a good strategy. So what I'm going to show you tonight is why you should entrust us, why we're a great manager, and why our strategies really make sense, and in combination we produce great returns to our investors. So our strategies, the manager is DLP, which you're going to hear more about us, and our strategy, we have two of them. So you're going to hear about two different strategies that we operate, two different ways we invest, two different ways you can invest with us. One is that we make loans to real estate investors, real estate bridge lending. We make loans to other real estate investors to invest in real estate. And the second thing we do is we're real estate investors, and we buy mainly apartment communities. So those are our two strategies that you're going to hear about independently here throughout this presentation. Why you should be interested in investing with us. I'm going to give you three reasons. First, if you invest with us as a fixed return investor, you'll earn fixed returns of 6 to 10% fixed returns on your investment. Those are locked in, guaranteed returns by us. On average, we pay our investors about 9% fixed return for our fixed note investors. Number two, if you invest in one of our funds that make loans to real estate investors, they have a target of at least an 11% return net to investors. And we've averaged significantly higher than that. And third, if you invest into our equity fund, our fund that buys apartment communities, we have a return goal of over 12% a year. We've always exceeded all of our return goals. And you get to protect your money from Uncle Sam. Our principles, what guides us in how we invest, first and foremost, even though I've been telling you about these great returns, that's not our guiding principle. Our first and most important principle is do not lose money ever. That is the most important thing that we focus on, is that we're making investments where there is very, very, very little risk of loss to our investors. And we're proud to say in over 10 years now, we've had no losses to investors in any investments. We haven't even missed a return target. Number two, and that goes to never missing a target, is consistency in returns. So it's really, really important to us that our returns are very consistent, not big ups and downs. If you're taking income from your investments with us, that we're paying you consistent checks or ACHs every month that you can count on. And then our third rule is refer back to rule number one. It's that simple. So we generate as high of returns as we can, making sure we're not exposing our investors to risk of losing money, and that we can keep our returns consistent. I'm going to show you how we've done that tonight. So what we do, I told you we make loans and we invest in real estate, but more specifically is we invest in people and in real estate. And when we say that and this is something we tell every employee when we're hiring people, it's something we talk about internally, what we do. We invest in people and we invest in real estate. But when we say we, we're talking about DLP and our investors, because your money, along with our money, investing in people and in turn in real estate, which will make more sense to you here in a moment. So the results of what we do is that we currently provide safe and affordable housing to more than 20,000 people who live in our properties in safe, desirable neighborhoods with affordable rents. We support and help more than 200 entrepreneurs right now who are growing their businesses, investing. We're providing them capital to grow their businesses and grow their communities. And we provide jobs to over 250 employees, some of which just stood up a moment ago, and support their families. And then lastly, but maybe most importantly, we generate consistent returns to our investors, which is you. So a little bit about us. This is the family of companies that we own. So as Larry mentioned, I'm the CEO and founder. I'll tell you a little bit about myself in a minute. But these are the family of companies that we own. It started off with DLP Realty 12 years ago, and we've expanded into all these vertically integrated businesses that work together, and you'll learn a little bit about tonight. So real quick though, it's Capital Partners, which is our business people invest in, our lending business, marketing company, property management, our real estate ownership interests, asset management interests, real estate partners, construction company, title company, or what some of those companies are. These are some of the people who lead our results here at DLP. This is our executive team. You'll see one of the people on the list. You'll see Barry DeGroot is around here somewhere. Where's Barry? All the way in the back. He's our general counsel, and he's a partner in the firm as well. And as of about 3 hours ago, is a resident of Palencia. He just moved from Pennsylvania. Yes, congrats. He's been living in Pennsylvania until just this week. Built a beautiful new home here in the neighborhood, and literally came here from the movers to be here with us tonight. So thank you, Barry. And a lot of other great executives. We have a COO, CFO. Our CFO is a partner in the firm as well. So a very quick little bit about myself. I've been in real estate for 12 years now. I started off as a real estate agent. Since then, I've now closed over 7,000 transactions, about $1.5 billion worth of real estate. I, along with our investors, own over 7,500 apartments and homes. I am the founder and CEO and majority owner of all of our family of companies. Ranked in the Wall Street Journal as the #1 real estate professional in Pennsylvania and New Jersey, top 10 in the U.S. And I'm the proud father of 2 little boys, Donnie and Alex. We live literally right on that street right there. And my wonderful wife, Carla. If you didn't join us earlier, our office is literally across the street here. So I literally get to have this walk to work each day. It's a great lifestyle here in Florida. We're driven by this purpose, living our dream to create prosperity through innovative solutions. And we really believe that, and these are our core values, we really believe that great companies solve problems. And that's what really great companies do really, really well, is they're able to solve problems. So to illustrate a little bit of how we got started in this business that led us on the path that we're on today, I'm going to tell you a little quick story. So when I became a real estate agent in 2006, I was a college student. I was about 20 years old. And from the very first day I had my real estate license, and people think, people talk about 2008 being the downturn of the real estate market. Believe it or not, the market actually started going down in the end of 2006. So the month I got my real estate license was the peak of the real estate market. That was the peak. So things only started going down for about the next 8 years, as many of you know. So from the very first day I had my real estate license, I realized that homes weren't selling quite as fast anymore. People were struggling with being able to sell their homes. So I came up with a program that I learned actually from a real estate sort of guru called the Guaranteed Sale Program. And from the very first day I was selling real estate, my marketing message was, your home sold in 68 days, guaranteed, or we'll buy it. And any home that we would have listed, like this home we had listed, on the sign out in front of the house, it would say, trade to this home and we'll buy yours. And that was, and still is to this day, except now we cut the time from 68 down to 34 days, but that has been our marketing message for 12 years. Never changed until 4 months ago when we cut it down to 34 days. So a buyer saw that sign on this house that said, trade to this home and we'll buy yours, and gave me a call. So I went to the house early for the showing. She wanted to come see this house. Her name was Lorraine. And so I got there early, and I was wearing a suit and a tie, and I got there early and got all the lights on and got everything all ready. And I introduced myself at the door. I'm walking her through this house. And finally, about maybe 20 minutes into this tour, she says to me, I'm sorry, honey, I have to ask you, who are you? And I said, well, I'm the real estate agent. We spoke on the phone. She said, oh, I thought you were the kid who cuts the grass, because there's no way you could have been the real estate agent. I was about 20 years old at the time. So, but that guaranteed sale program grabbed her attention and started our relationship. And she didn't end up buying this home, but this home gives such a great example in this story because that same client did end up buying a home with us, and we guaranteed the sale of her home and sold her home. I later bought her mother's house from her, and we ended up flipping her mother's house. She's currently an investor of ours, ended up investing capital with us once we had those investment options. And then this actual home, I actually owned this home. I bought it as a short sale through our short sale negotiation company when the market was going down. Turned around, sold it, and we actually have this home listed now for the new owners, literally as we speak right now, oddly enough. And the funniest part about the story, so it lays down the path of how we create solutions. So we started a short sale negotiation company to solve when people were upside down in their homes. We started flipping homes because we had people in distressed situations and couldn't wait. So we started all these programs to solve problems. And the funniest thing about this home is I actually did cut the grass just about 2 or 3 years earlier, and that's how I got the listing, is because I knew the owners. So a little bit about our track record. That's how we got started, but since then we've grown quite a bit. So our track record is that we've achieved our targeted returns to our investors every single month in all 7 of our investment funds for now going on, in our funds going on about 6 years. We've had investors for about 10 years. We've never missed a target. We've generated double-digit returns to all equity investors in all of our funds. We have 0 principal losses, and we do now have, it says 6 there, but we now have 7 real estate funds. We are one of the 5,000 fastest growing companies in America, which is a good honor because only obviously 5,000 companies make that list. But what we're really proud of is that this is now our 6th year in a row on this list. And to make this list, you have to grow X percentage over 3 years is how they measure your growth. And we are the 10th fastest growing company in America out of all industries that have been able to be on this list 5 times or more ever. Because very seldom do companies maintain consistent growth year after year after year, which we've been able to do, which is a testament, and our investors feel that in the consistency in our returns. So currently we have over $500 million in assets. We own over 7,500 apartments and houses, over 300 loans to other investors. We have 7 funds. We have over 500 investors invested with us today. And again, 0 losses. We have 270 employees, and we do about $100 million a year in annual revenue. And we're still growing. So you might be thinking, I just showed you all that. Why did you invite me out here to dinner? You guys have already done all this. Well, we're still growing. So our expectation, our goal that we've set, our commitment we've set is that by 2022, originally the goal was 2025. We cut it to 2022. We will be $2 billion in assets. So right now it's $500 million. We'll be $2 billion by 2022. That means we'll own over 15,000 apartments and homes, over 1,000 loans. We'll likely have over 1,000 investors. I don't know where we're going to hold our investor events at that time. Right now our investor events in Pennsylvania, which we do once a quarter, and we'd love for you to join us there, have over 300 investors at those events currently. Again, we'll still have had 0 losses to investors, even though, yes, we will go through a recessionary environment, and we'll have over 500 employees doing over $250 million in revenue. So that's in 4 years from now, 3.5 years from now. So a little bit about DLP Capital Partners, how we manage money. So I have 2 partners, Bob Peterson, our CFO, Barry DeGroot, our general counsel. We are today institutional in quality. You can invest with us through your brokerage account, through Charles Schwab, Fidelity. We have multiple family offices, wealth managers who invest their clients' money with us, and of course many investors who do so directly. Here's our offices. So we're the office on the top right, we moved in 2 months ago. Literally it's the office right next to us. Top left is our headquarters in Pennsylvania, but literally don't tell all my Pennsylvania employees yet, but we literally bought a new company headquarters yesterday in Pennsylvania, a 74,000 square foot Class A office building that we'll be moving our Pennsylvania headquarters to probably on January 1st. We have an office down at the beach here in St. Augustine, an office in the Poconos, Pennsylvania, and we have an office down in Daytona Beach. Those are our corporate offices. 500 plus investors already mentioned. Many of our investors are invested in multiple funds with us. This map here shows you, in red, shows you all the states that we lend money in, all the states that we're providing capital to other investors. Some of these states, you'll see there's nothing inside of them because we don't currently have any loans or properties in those states. And this is in the brochures you have as well. The numbers in red are the number of properties we own, and in blue are the number of loans we have to other investors in each of these states. So we do a lot of investing here in Florida, Georgia, South Carolina, North Carolina, and then Mississippi, Alabama. So we do a lot of investing in the Southeast. And then we also own a lot of properties in Pennsylvania, New Jersey, where we're headquartered.
What happened to Tennessee?
Tennessee?
You have no investments?
Yeah, that's a good question. This gentleman over here, his name is Anthony. He's our director of acquisitions. You can come talk to him. We got to fill in that state. We've gotten close a couple times. This shows just our apartment communities we own mapped across, and some of you saw that at our office as well. This shows the communities that we own throughout the South, and you'll notice, we were only in Florida and Pennsylvania, New Jersey until about 2 years ago, and you can see we've been filling out the rest of the Southeast. So why should you be interested in investing with us? Well, first thing that I think is really important about investing with us is everything's transparent. So if you have not already received a login to DLP Crowd, you'll log in after this meeting, and you can actually see all of our fund performance and all of our funds, the actual balance sheets, income statements, asset tapes, third-party audits by outside CPA firms, all of our historical financials. So you always know what we're doing, how we're investing your money, what's actually going on, and see our real financials. So there's no black box. You have 24-hour access here to see all your account statements, all your signed documents, everything you could want to see about your investment. And then we have two strategies I talked about that I'm going to cover. I'm going to cover these independently here. First, I'm going to talk about our private lending strategy, how you can invest in this strategy, and then how you can invest in our multifamily strategy, and why you should be interested in one or the other. So first, we make loans to real estate investors. So why do we do this? Why is there an industry for this? So that home flipping, people buying single-family homes, distressed homes, is a $12 billion a year industry. It's a very big industry. It used to be that if you were buying real estate, you'd go to a local community bank for a loan on a house. The community banking industry, due to regulations, has really stepped out of this space and really probably won't come back into it. So it's created a big need for private money here. We're in a country with aging housing stock. The average home, I believe, in America today was built in 1952. So a lot of homes that are aging that need to be rehabilitated. And borrowers looking to rehabilitate these homes, create affordable newer housing for people, need a lender who can provide them the capital and who can move very quickly. And we only lend short-term loans. So banks like to lend long-term loans where they're going to collect payments from you every month for a long time. We make loans that are 6 to 12 months. Our average loan is only for 8 months. So very different than bank financing. And probably the best way to describe why we have this business is, have any of you tried getting a loan from a bank recently? If you have, you probably know how challenging and how frustrating that is. If you went to a bank today and had, say you had $1 million sitting in the bank, and you were going to go buy a house for $500,000, and you only wanted a loan for $100,000. You said, I'm going to put $400,000 down, and I have $1 million in your bank. You'd still struggle to get that loan done in less than 2 months without having to go through endless paperwork and challenges. Banking is under a lot of regulations. And most of the borrowers who are buying our properties are buying foreclosures, distressed deals. They have to be able to move very fast. Who we lend to? So we do not lend to this person. It says, I'm sorry, but do you have anything other than a wife and a cat to offer as collateral? So we lend to experienced, successful real estate investors who have, on average, our average borrower has about a $2 million net worth, has close to a 700 credit score, has $200,000 to $400,000 of cash, and has completed at least 15 investments. That's our average borrower. So successful, experienced investors who are actually bankable, but don't want to deal with the challenges of working with the bank. The next thing that's really important in how we lend is how we go about mitigating risk. So in addition to lending to good borrowers, we lend on average only 55% loan to value. So there's a lot of equity in the property above our loan. On average, we're lending 73% loan to cost. That means the borrower put 27% of their money into the property. So I know a number of you who've been here before have seen me say this before, so please don't give the answer here. So from 2008 to 2013, which was the real estate recession, the mortgage meltdown. Take a guess at how many foreclosures there were in America. Just a guess. You can shout it out.
0.
Not how many we had. How many foreclosures were in the entire country? How many homes do you think were foreclosed on? 2.2 million, I heard.
10 million.
10 million.
Is it Price is Right?
It is not. So 10 million, 2 million. So take a guess. What percentage of them put 20% down? Out of the 10 million or 2 million or whatever the number is, what percent? 5%? 5%? 1%? 0%? So there were over 10 million homes that foreclosed from 2008 to 2013. Less than 10,000, which is less than 0.1%, had 20% down. So that doesn't tell you something as a lender on what's important when you make a loan. I don't know what does. So we do a lot of things to mitigate risk in our loans. I've covered a couple of them. I'll talk about a couple more. But if we just simply made sure our borrowers put 20% down, our chance of losing money, number one, on a loan, let alone our chance of foreclosure, would be very low. So that's our number one focus in making loans, is skin in the game. So again, we lend to strong borrowers, and then we also go out and physically inspect the properties we lend on. We go out and actually have an inspector walk the property. We get a third-party appraisal. We do our own internal valuation. So we thoroughly evaluate the property before we make a loan. These are a couple examples. I know it might be a little hard for some of you in the back to see these, but these are just a couple example types of homes that we lend on. So this is a little tiny house, little average house. That's what the house looked like when they bought it. Just needed updating. So the borrower had completed 41 real estate investments for over $28 million. The borrower had a 734 credit score, and there was a co-borrower who had a 660. They had a net worth of $1.3 million and $4 million respectively. This was a very small property, but we did a loan for $41,000 on a property worth $105,000 at 12.99% interest rate for 6 months. And then they came in and renovated the house. You can see some finished pictures. They sold it in less than 6 months for $110,000. We put a value on it for $105,000. Our loan was $41,000. Here's another example. This doesn't have an outside picture, but of another home that we recently did. The borrower was an experienced real estate agent, sold hundreds of homes, had done many flips, had a real estate portfolio worth about $800,000, 620, 650 credit score, net worth of $1.3 million. We did a loan for $95,000. It was a $145,000 value, 65% loan to value, 6-month loan. They came in and redid the whole house, new kitchen, new baths, new flooring, new lighting, and sold it again in under 6 months for over the value we put on it. These are the types of loans we do, $100,000, $200,000 homes. Usually our average loan is about $180,000. Average house is $250,000, $300,000 finished home. And we do this throughout suburban markets across the U.S. We're not really in a lot of major cities. We're in suburbia USA. This here says, I heard flipping houses is a great way to make money. So there's a lot of people who watch HGTV and want to be home flippers, and more now than probably ever, we really focus on lending to people who know what they're doing, and then also providing them with guidance and education and training and resources to protect them. So in this strategy, how do you invest in this strategy? We have 2 different investment funds that are very similar. I'm going to kind of explain them as one because they're so similar. One's called the Lending Fund, one's called the Income and Growth Fund. Again, they're both in those brochures that you have. So I know it's a little hard to read in the back, but if you look in your brochure, you can see it. But I'm going to give you the highlights. So the benefits, the great features of this fund, first of all, is you can redeem your investment anytime with 90 days notice. There's no long-term commitment. You go into this fund, you can redeem out with just 90 days notice. It's very, very liquid. We pay out all the profits monthly. So we distribute all the profits monthly, or you can let it compound and grow, and it'll compound every month. It has a preferred return goal, which is how much we pay to the investors before we get to make anything, of 10%. That's an annual 10% return. And the target return is to generate at least 11% to investors. So to achieve the preferred return plus at least 1 additional percent is our goal. This fund has been open since 2014. And this is our track record. Again, I know it's hard to read in the back, but we've averaged 14.53% annual net returns to investors. distributed out monthly. We've exceeded our return target every single month. Our worst annualized monthly return was 12.33% going on 5 years in this fund with 90-day liquidity. So you're going to get double-digit returns with monthly cash flow and the ability to redeem very quickly, highly liquid. Income and Growth Fund is very similar. It has a shorter history and to date has been a little bit lower returns, has the same 11% target. We've averaged 12.4 so far. We've still exceeded the target, but now the fund's growing. We expect it will actually, if we had to take an educated guess, we actually think the Income and Growth Fund will slightly outperform the lending fund over the next year. So you can invest in both of those funds as what we call an equity investor or a limited partner, or you can invest in those funds as a note holder or as a fixed return investor. So as a fixed return investor, you commit for, it says 1 to 5 years, but actually the 1 year commitment is only a 90-day commitment now. So you can commit as short as 90 days or as long as 5 years, and then you'll receive a fixed return on your investment depending on how much money you invest and depending on how long you choose. So the amount goes up based on the amount you invest and for how long you choose to commit. That's a fixed return. It's guaranteed by us. It's not guaranteed by the FDIC, but it's guaranteed by us that we have to pay you this return. We send a contract obligating to pay you this return. You can take distributions every month. You can let it compound and grow. You can do a combination of both. You can switch at any time. The chart on the left shows what your return would be if you took the distributions every month. The chart on the right shows you if you let it compound and grow what your effective return is. So what's really great about this, we say we're big on consistency in return. Who here has heard of the rule of 72? Few people? All right. So the rule of 72 is if you take the number 72 and you divide it by your return, if your return is consistent, it'll tell you how long it'll take your money to double. So example, if you invested here and received an 8% fixed return, 72 divided by 8 means it'll take a little bit less than 9 years for your money to double. If you took 9%, it would take you 72 divided by 9 would take you about 7 years for your money to double. I'm sorry, a little bit less than 8 years for your money to double. So that's a great, comfortable feeling where you can sit there and you can figure out how much money you're going to have in a year, how much money you're going to have in 2 years, how much you're going to have in 4 years, if you're letting it compound and grow, or if you're looking for income, for you to know my check is going to be this amount every month. You know exactly how much it's going to be and it's not going to change. All of these returns are net, meaning there's no expenses that come out of them, not $1. If you have to pay a wire transfer to send the money to us, we pay that wire transfer. If you invest through your IRA, through your retirement account, which you can with all of our funds, we pay the account fees to your IRA. These are absolute returns that nothing comes out of them. So I just said utilizing your IRA, it says this is our retirement plan. So, you know, for a great thing, right, is we're all living longer than ever before. It means we all have a longer horizon than we probably originally thought. And, you know, retirement's a big concern. Not having consistency in return, ability to live off the income versus having to eat away at principal is something we really focus on. And how we started, our first 3 or 4 years of managing money, all we offered were these fixed notes. There was such a big demand back in 2008, 9, 10 for a safe place to put your money and get consistent income you can count on. So, our second strategy, that's strategy 1. I'm going to cover the second strategy, and then I'm going to wrap it up to questions. So, strategy 2. First question I'm going to ask you before I explain strategy. Who likes giving Uncle Sam 1/3 of their money? Nobody? So this is a strategy if you want to protect your money, shelter your money from tax. So what we do is we buy apartment communities. So we buy typically 150, 200, 300 unit apartment communities throughout the Southeast. Affordable B-class apartment communities, typically that have some sort of need to, a value add as we call it. Usually we have to go in and do some renovations, improve the management, etc. These are some examples of some of our communities we own. As I said, we own 7,500 apartments and homes today, about 7,000 apartments, and all throughout the Southeast. We have in-house management is one of the key ways we mitigate risk is strong management in-house. These are some of our leaders here who manage our properties, our regional managers, our executives, and we have a new asset manager, Chastity, who just joined us here in the past week, who's going to really help us drive returns and returns to our investors and drive productivity. So how we mitigate risk, though, the real focus on this strategy, what makes this strategy we think so great today, but even more so as we go through the next real estate market, is that we're investing in affordable housing. So right now today, all apartment classes, all real estate, really, the market's on fire. Prices keep going up. B class, C class apartment communities, which means apartment communities that aren't luxury. Apartments that were built back in the 70s or 80s or early 90s. They don't have all the luxury amenities. $800 a month apartments instead of $1,800 a month apartments. Who lives or goes through Jacksonville at all regularly? A number of you? So anybody seen all the apartments being built in Jacksonville? Right? Over 10,000 apartments being built in Jacksonville right now. The average one-bedroom rent is $1,800 a month in Jacksonville, right? So we focus where our average rent in our community in Jacksonville is about $800. But first and foremost, before I get into that further, even in these types of apartments we're buying, right now the market is so saturated that people are buying these types of apartment communities that we buy at 5 and 6 cap rates. Meaning if they bought the property all cash, they get a 5% return on their money from the rental income. We focus on buying where we're at least an 8.5 cap rate, which basically means we're paying 30 to 50% lower prices than where a lot of other buyers are, which means we have to be very disciplined. We can't. It's much easier to go buy big, beautiful properties that are well managed, that are performing well, and buy them at a 5 cap rate, and our job is much, much easier. But by doing so, it exposes us to a lot of risk. So in this strategy, one of the big ways we mitigate risk is, first of all, is debt. So a lot of times people say, well, what's going to happen, Don, when interest rates go up? Because interest rates will go up. We lock in all of our loans into long-term, non-recourse loans, usually 10 to 12-year loans where our interest rates can't go up, locked in through the entire term of our investment. So we're not exposed to interest rate change. Again, we focus on B and C class apartments where we're at least an 8.5 cap rate, meaning if we didn't have any leverage, we generate at least an 8.5% return to our investors just from the rental cash flow, not counting in appreciation, not counting any of the value we create, just off of the cash flow. The properties have to produce at least a 12% cash-on-cash return at the asset level, and must generate at least an 18% overall return, assuming we sell the property in 5 years. These are the non-negotiable requirements in order for us to make an investment. In order for us to find deals like this, it takes us a lot of work. We evaluate probably at this point now over 1,000 deals a month. And we put them through a detailed process where we're literally going out, walking these properties, inspecting these units, checking out the competing properties, pulling crime reports, evaluating the tenants, evaluating the management, underwriting the local market. So we'll go out to 40, 50 deals a month that we'll do full financial analysis, 20, 30 properties a month that we go out and visit, 15 to 20 offers we'll put out a month, and we'll only buy 1 or 2 properties a month. So people say, well, how do you find these great deals? Well, it takes a lot of work. It's hard to find great deals in this market, but if you have this big a funnel enough, you're going to find some good deals. So we only buy 1 or 2 properties a month, but it takes us a lot of man hours, hundreds and hundreds of hours, tens of thousands of dollars we spend sometimes on deals that we don't end up buying. But we have to do that to mitigate our risk. So it's a very detailed process that we go through to make sure we're buying great properties at great deals. Again, these are where our properties are located. And then many of the properties we buy, how we get value is also we're willing to do heavy lifting. So example, right now we're buying a property in Titusville, Florida that was damaged through the hurricane, and it's 100% vacant and needs renovation. We have to go in there and spend a couple $1 million in capital improvements and redo over 100 apartments. So very often we're coming in and redoing apartments. A lot of times this is an example of one of our apartment communities in Brunswick, Georgia. Kind of what there were 40 units that were completely down, meaning they were unrentable when we bought it, and then we came in and turned them into this. So very often we're going in and spending $6,000, $8,000, $10,000, $12,000 per apartment to renovate them with new flooring, new lighting, usually new roofs, new windows, and making them great places to live, low maintenance costs, attracting better tenants, increasing our rents, driving up the value of the properties. This is a community here. This construction, these are single-story apartment communities. It's called Cardinal Construction. We own 9 apartment communities that look identical to that throughout the Southeast. Very often the units look identical to that when we come into them. And that's a unit had some mold in it, kitchen was completely destroyed, no HVAC, just a wreck. And this is what the community looks like now. We come in, clean up the outsides, make it an attractive place to live, and then come in there and fully renovate. Almost always all hard surface floor, fresh colors, fresh paint, make it a nice place to live. And again, this is an $800 a month apartment where somebody can afford to live there. We look at added value in situations of where it shows on that board there, 2 + 2 = 5. We're coming there and spending money to increase our return. And almost every property we buy, we have to do a pretty significant added value play, a lot of heavy lifting. So why do we invest in multifamily? So first of all, rentership is on the increase, is increasing, homeownership is on the decline. That's been happening now for over 10 years. Most people expect that to continue. That people want to be renters. Number one, a lot of people don't have the desire to be homeowners, especially the younger generation. Even those who do are starting their lives later. So the average age somebody gets married today, anybody want to take a guess? 31? 37. Which also coincidentally is the same age the average person buys their first home, 37. So people are starting much later in life. The desire to be a homeowner and the affordability to be a homeowner continues to decline. We're in a more transient society. People want more flexibility. So rentership's continuing to grow. Why we invest in the South and the Southeast more specifically is because since people are more transient, where do they want to go? Warm places, right? How many people in this room came from a colder place and moved to Florida, right? That trend is not going to change. So we go to places where there's strong job growth, strong population growth, which in other words means strong demand. So there's a demand for apartments. And most of the job growth, Jacksonville's a great market. Jacksonville's arguably, top 5 best job market in the country right now. Have an enormous growth. Those jobs coming to Jacksonville are not $100,000 a year jobs. They're $40,000 a year jobs. People coming to Jacksonville aren't making the kind of incomes to support the type of housing that's being built. So strong demand, and there's no new supply. So you might be saying, what are you talking about, Don? You just told me there's 10,000 apartments being built in Jacksonville. Everything being built is Class A. Everything being built is luxury. There's nothing being built that's affordable. Rents have gone up 62% in America since 2008. 62%. Incomes have not even gone up 10%. There's a great article I'm going to be sending out to all of you that a Harvard study was just done on this that it talks about it's an epidemic in America today for affordable housing. A market like Seattle is one of the top real estate markets in the country. Highest home prices, markets on fire, prices keep going up. Every percentage that home prices go up, homelessness goes up equally. It's got the highest homeless rate in America in one of the wealthiest, hottest markets because people are being kicked into the streets because they can't afford to live anywhere. I mean, literally, there's such a lack of affordable housing all over the country, and there's no solution for it. There's no new supply coming anytime soon that's going to solve this need. So that puts us in a great position. We go into secondary and tertiary markets, meaning we don't go into the big markets because there's less big institutional competition to compete with, and we can get stronger returns because of that, and we get more diversification. We're not tied to one city, one main employer. We get a lot of diversification. Again, B and C class properties are not luxury properties, usually built before the 2000s, usually rents under $1,000 a month. So how do you invest in this strategy? This is our third fund that we've done that invests in owning real estate. It's called the Preferred Return Equity Fund. So this fund's very different than the previous funds I showed you. This fund has a 6 to 8 year investment time frame. So you invest in this fund, you'd only invest in it if you wanted to be invested for the next 6 to 8 years. But you can redeem out with a 180-day notice if you need to. This fund has a 7% preferred return, what you earn before we earn anything. We do not even earn our management fee until you get your 7% return. So we literally don't get $1 until you get 7% return. Our goal is at least 8% returns paid out to you from cash flow. We pay that out quarterly. So to use simple numbers, if you invested, and just make the numbers easy, invested 500 grand, 40,000 a year is 8%. So we'd be distributing out to you $10,000 every quarter, 2% of your investment from income off of operations. The overall return goal is at least 12% annual return net to investors. So you get that 8% return paid out every quarter. When we sell off all the properties in 6 to 8 years, we're going to return back to you 1.5 to 2 times your original investment. While we operate this fund, all the distributions we pay out to you, almost all of those distributions are going to be sheltered from tax through depreciation. So if I distribute to you $40,000, you'll likely only owe tax on 5 to 10,000, potentially have no taxable income while we operate over the next 5, 6, 7 years. So you keep Uncle Sam out of your pocket, and you get the benefit of your money growing versus giving it to Uncle Sam each year. And then at the end of the fund, when we give you back 1.5 to 2 times your original investment, you now pay long-term capital gains instead of ordinary income. None of us know where that will be at that time, but historically and today, it's about half of where most of our marginal tax brackets are, about 16, 17% instead of 30 plus percent. So it's much more tax efficient owning real estate. One of the great reasons why Donald Trump doesn't give his tax returns, because he doesn't pay any taxes because of depreciation. It's a big way to shelter your income. So that would be one of the biggest reasons you'd go into this fund. It should have the highest return target of highest returns of any of our funds, but the biggest reason I believe is if you factor in the effect of tax, it really increases the benefits of going into this strategy. Last thing I'm going to touch on with this fund that's very unique. First time we've structured a fund like this, and actually I've never seen a fund structured quite this way. So when we buy a property, we take out a loan, usually for 60 to 70% of the cost. And then the fund will put in about 15 to 25% of the cost, that blue area. And then there'll always be common equity, meaning there'll be somebody else, either myself and or other real estate investors who put in the rest of the equity, and their equity is subordinate to yours. What that means is when cash flow comes in off of rent, the fund takes all of the cash flow, and the fund gets a 10% return on its money. So investors get all the cash flow until a 10% return is distributed. The common equity doesn't get anything until that happens. When we sell the properties, the fund gets a 12% annualized return on their money, gets all of their money back before the common equity even gets their money back. So I could lose money on a deal and investors could earn 12% annual return. So it shelters you. So anybody who wants to be very pessimistic and say, well, we're going to go into a recession here. How am I protected? I already explained why the strategy protects us, because there's going to be big demand for apartments, rents are going to stay strong, occupancy is going to remain strong, but we also often have $1 million, $2 million, $3 million of equity invested behind our fund's equity protecting the fund. Every deal is done that way. And last thing I'm going to mention, I'm not going to explain this much, but very soon you'll be able to invest with DLP through a life insurance plan or an annuity. So if you right now have an annuity or a life insurance plan with cash in it, and it's not performing, which most annuities aren't performing, you'd be able to roll over your annuity or your existing insurance plan and have your money invested in our funds, sheltered from tax within an insurance product. So that's a new opportunity that'll be open here in about 2 months, and be another opportunity to be able to invest a different kind of your investments with us. So I know you're thinking, wow. If you're interested after this, next steps are to schedule a one-on-one. Larry will follow up with you, with myself or Larry or Mike, our director of development, who's around here, and we'll sit down and chat with you. Or you can we'll send you a login to DLP Crowd, where you can go and do your own homework, look at our past financials, our audits, our historical information, and get even more comfortable. So with that said, and again, DLP Crowd gives you full access to everything you want to see. So with that said, I'm going to open it up to questions. After questions, we're going to, actually I'll cover it here quickly first. Our upcoming events, if anybody here wants to join us in Pennsylvania, and a number of our Florida investors have done this, you can come join us. July 19th, we'll host you in beautiful historic downtown Bethlehem at a great hotel. You can come meet 120, 130 of our investors, meet 100 employees, and get a better understanding of the company. Love to have you come join us and see our big event. We also stream those events live as well, so you can watch them from here as well. And then we're going to do a raffle here after questions as well and give away some real cash. So with that said, I'm going to open it up to questions.
Tell us a little bit more about the trends in the rehab or the flipping market. Are you seeing that declining? So when you look at your equity, I guess it's the equity fund, or yeah, in any case, do you see that kind of growing, or do you see that stabilizing? Where does that stand?
So you mean the industry as a whole, or us flipping homes, or lending money to other people to flip homes? The industry in general. Okay. So the industry of flipping homes is bigger today than it's ever been, but it's harder today than it's ever been to find deals. There's less distressed deals out there. There's so many people in the business. It's harder and harder to find deals. So there are a lot of people still doing it really well, but then we've seen a lot of good operators go in two directions. They either A, have moved into multifamily real estate, like we did, and we lend money to other multifamily operators too. And also they've gone in the direction of building new houses, and which is a huge need, as we've been talking about in most markets, for affordable housing for rent, but also affordable housing to own. So actually in the room over here is Oren. He works with, we actually lend money, and actually I own a bunch of lots with Oren that we're building houses on in Gainesville. But Oren builds homes throughout Central Florida, and started off owning and owns hundreds of single family homes, renovated them, and then realized this big opportunity to build in this market. So now builds lots of affordable homes, $220,000, $230,000, $240,000 homes throughout Florida, and does it in a very unique way. So we've seen a lot of really sharp operators realize that this is a great opportunity to build, and have moved in that direction. So that's been a big kind of shift in the industry, I'd say over the last 2 or 3 years. And recommend you chat with Oren about it, and it's pretty interesting.
I get about 2 or 3 newsletters from various economists every morning, and everything from international currencies, metals, gold, silver, all that stuff. And just about everyone, the consensus is that we're heading into a big recession. There's so much debt right now, government debt, individual debt all over the place, and if they think this is going to happen, and fairly near, it's not the long-range type thing. What do you think this is going to be doing to your various funds, and how are you trying to work to protect whatever you can?
Yeah, great question. That's the big question we all have, right? Is a recession is going to come. It always comes. There'll always be another recession coming. I would have, if you would have asked me, when I thought it was coming a month ago, I would have told you, within the next 2 years. I was just at an event in Palm Beach, a big event with a lot of economists there, a lot of experts there, and they study a lot of trends, and really every trend points in the direction that we have at least 2 more years before there's any recessionary environment. Kind of all the quote-unquote experts there really feel it's 2.5 to 3 years before you see some major recessionary issues. But it will be here. So whether it's 2 years or 3 years, it will be here. So that's why we think our strategies are so great, is that we know it's going to happen. So again, we have 2 strategies. So if I take the first strategy, lending, our loans are only for 8 months on average. So we're not going to be stuck in loans where I wrote a loan for 10 years and now the property values are going down and I'm going to be upside down on my loan. We're going to be able to exit our loans in a very short period of time. Our loans on average are for 55% loan to value. Even in the last downturn, even in Florida, property values didn't go down 45% in 8 months. That doesn't happen. So worst case scenario for us in our lending business, which we don't think is the case, is we can't make any more loans because the market's crashing and we have to return people's money back to them. I mean, that's the worst situation. We're not going to be stuck with a ton of loans going into foreclosure and losing money. So that puts us in a really good position why we don't do long-term loans. It's way easier to write a loan for 10 years and collect payments every month than to have to re-originate all of our loans every 8 months. 40% of all of our loans will be paid off in the next 90 days. And I got to rewrite all new loans, originate all new loans, do all the work all over again. But it's the best way to mitigate risk. Then when it comes to our multifamily properties, so from 2008 to 2013 in affordable apartment communities throughout the U.S., rents went up and occupancy went up. So even though the market was crashing, even though home prices went down 50, 60, 70%, even though there was all this distress everywhere, people still need somewhere to live. The affordable apartment communities had rents go up, not huge, but went up, and occupancy went up. So we believe that even when the next downturn comes, people are going to keep renting our apartments. We might not have the same kind of growth we've been having in rent, but we're going to be able to maintain very consistent revenue. And because our debt's locked in long term, we're not going to face capital calls on our debt. We're going to be in a great stable position to ride it out, and that's why we make our fund terms longer. So our last fund was called the Equity Fund 2. That was an 8 to 10 year fund because we didn't want to be in the position that we had to exit at the wrong time. This fund is 6 to 8 years that invests in multifamily. So again, we can weather that next downturn and not be stuck having to try to sell our properties at the wrong time. So, did that answer your question?
Yeah.
It's a big question, but I'm happy to talk about it more. Hey, how are you?
Hi. Do you raise your rates every year on if you're renting, are you going to raise it in a year? And I don't know if you said when you lend out the money, do you have a percentage that you
Lend it?
lend?
So first question, do we raise our rents every year? Yes. I'd like to raise our rents every day, but we do so usually more monthly. So we are, even though we're in affordable housing, we're not going to not capitalize on the opportunity to rents are rising. So, our year over year rent growth goal is 5% per unit on the same unit in the same condition. But then we are often going in and renovating units and increasing the rents a lot more. So yes, our rents are going up. When we buy a property, we assume rents will only go up 2% a year. Even though we've seen more like 7 or 8% a year, we only assume 2% a year, which is much lower than historically it's been. And for the last 10 years, rents have gone up 62%. But we underwrite very conservatively there. Second question was, what do we charge as an interest rate to borrowers? Our average interest rate to a borrower today is 12.3% interest rate. So it varies a good amount, but on average a little over 12%. But it's a short-term loan. They're only having that loan for 8 months. So it's not as focused on interest rate when you're not owning it long-term. It's just a cost of the deal. Great question. Did I get them both?
No, I have another question.
She always does.
Okay, do you have a lot of foreclosures on people that aren't paying their rent?
So we've done about 1,000 loans so far. In our lending business, we've had 4 loans that have gone all the way to a workout situation. Now, for actual disclosure, our funds have had no workouts, have had no defaults, because when a loan gets to serious default, I actually just buy the loan myself. I pay the fund off, all the past due fees and expenses and everything. So I actually handle the workout myself, and the fund gets 100% of all the fees. We've never written off $1 of interest, $1 default interest, $1 of late fees, nothing, ever. So we've collected 100% of every dollar of interest owed to us on every loan we've ever done. We've had 4 loans go to workout, never all the way to sheriff's sale. Those 4 workout situations were 3 what's called deed in lieu, which is voluntary foreclosure. They hand the property over to us. Each one of those situations, we turn around and resold the property for profit, modest, but for profit. And then one time we just bought the property from the seller. There was a ton of equity. We actually bought the property for him and gave him agreement that when we turned around and sold the property, we'd give him 80% of any profits we earned, which we did, and gave him another $300,000 after we'd bought the property from him. So he was thrilled because he was about to lose the property to a tax sale. I mean, it was a big mess. But so those are the only 4 situations we have. Right now we have probably 3 loans that will go into probably deed in lieu, probably be the likely outcome. Again, we're not expecting to have any losses on any of those loans. And we actually do fund what's called a loan loss reserve account, which we actually fund that out of our fees. It's an account that sits there with money to cover any losses on a loan. Never had any losses on a loan, but we actually put money aside that's our money, not yours, that we sit as in case we ever did have to write money off on a loan. I think right now it's about $120,000 that sits there. If we had to write off money, it wouldn't come from the return. It would come from performance fees that we've held back to build up this account. That answer your question?
That answers my question. I have another question. If I were to find a property that I gave you that you bought, would you pay me money to give you this property that you bought?
So actually we probably have 20 investors who we've bought their real estate portfolio, or at least part of it from them. And then in turn they invested that money passively with us and realized they get much better returns passively with us than they were getting actively on their own. So yes, we've done that for many people. We've come in and purchased their single family homes, their apartment communities, and had them reinvest that money with us. So yes.
I was looking at the DLP note offerings. One question, why, like if I invested $100,000, do I get 8%? And if I invest $250,000, it's 6.5%. Yeah,
you have it a little bit upside down in this. I think what you meant though was, so if you invest $100,000 to $250,000, the return for 1 year here is 6.5%. For $250,000 to $1 million at 7%. For $1 million plus, it's 8%.
Oh, million, okay.
Yeah. So as the investment amount goes up, the yield goes up, and it's really just for us, it's the amount of work that goes into managing the relationship. If somebody invests more money, it's less work, so we're able to give out a little bit incremental higher return. And then, and also mentioned, if you invested, say, $100,000 today, as an example, and a year from now you added $150,000, then we move your whole investment up to that larger amount. Also, if you came and you said, all right, I'm going to put $100,000 into a fixed note, and I'm going to put $150,000 into one of the other options. We look at you as one account, and we say, all right, you have a total of $250,000 with us, So we give you the rate of 250 grand, even though it's not all in that one investment offering. We look at it as your total account size with us. And that includes you, your significant other, IRA accounts, any type of account you have. We add it all together in how we look at your account total.
A follow-up on that, if I invested 100,000 and I said I want to do it for 5 years at 7.5%, but I decide in 1 year I want to get my money back, does that take me down like to the 6.5, or how do you adjust that where people don't come in and say, I want this and then pull it out?
Got it. Yeah, that's a great question. So we work a little bit on the old Boy Scout honor system. So we just tell investors, if you tell us you're going to come in for 5 years, that be your goal. But life happens, good and bad. And if life happens good and bad, and you need to take your money out early, we've never ever charged $1 of fees, penalties, ever come back and say, oh, you owe us back 1% interest rate. We just work on honor system. Life happens. We don't charge anything. We can typically redeem investors out in a matter of, if it was 100 or 250 grand, matter of a week or two, and there's no fees or penalties to that. So it's really, we go into it saying, hey, you're looking at this longer term. We're expecting you to be a longer term, but stuff happens. So, at least once a month, somebody has something that comes up and they need to pull money out. And there's never, for any of our options, there's never a fee or a penalty to that. Get it?
I think so. And if I do invest that, what type of fees do I have if I go put 100,000 in?
No fees. Okay. So those are absolute returns. I mean, anybody. My youngest is 5, and he can figure out how much money he'll earn exactly in the next year in an investment with us, because there's nothing that comes out of it. I mean, it's literally, you invest 100,000 at 6.5%. You take distributions every month. You got $6,500 in distributions. It's that simple. Divide that by 12, tells you how much you'll have each month. It's literally that simple. Or if you look at the other chart, you say, I'm not going to take the distributions. I'm going to let it reinvest. Well, 1 year from now, that 100,000 will be $106,700. It'll earn 6.7% return over the next year, compounded yield. There's not a fee that comes out of it, nothing.
Thank you.
Great questions.
So in the world, you've got a great business model here. But in the world of business today, our marketers love to copy success.
Sure.
So I'm sure there's multiple companies trying to replicate what you've done. How have you prepared yourself to protect us from the market getting saturated with people doing the same thing so you can continue succeeding?
Yeah, great question. So, first, we're in a lot of different businesses. So a lot of people copy one of our businesses. I don't know anybody who's trying to do all of our businesses or try to have, an overall business model that does, everything that we do. But if you take any one of our businesses, for example, and it's always been kind of funny in our real estate business in Pennsylvania, or selling real estate, our marketing message has always been, your home sold in 68 days, guaranteed or buy it. Up until just a couple months ago, every time somebody copies it, which has happened at least 20 times, they choose more days. I never understand it. So they'll choose 69 days or 72 days or 96 days. I never understand it why somebody never would say 67 days even. But at least 20 times people came in and copied the same message, went to the same places to market it. We have some people from our local radio station here. They'll go on the same radio stations, market the same message. But usually, they have to execute really well, and then usually they don't actually have the money to do it. So it's more of just a scam than a real program. And usually they last 3 months, 4 months, and they realize it's hard and they stop. And so that happens a lot of times. One way we've avoided that is we don't really look at most other real estate investors as our competition. We look at them as our partners. So instead of fighting for every deal to go by, we decided let's fund other people on their deals. So we want other people to learn everything we know in the world of flipping houses, the world of investing. We train and teach almost every week. We're running trainings and teaching other investors because we want them to be successful and borrow money from us. Now in that, I explained in that last fund, that the preferred return equity fund, that somebody else puts in common equity in every deal we do. Well, that common equity is often another multifamily real estate operator who finds a deal, brings that deal to us, and we partner with them on that deal. So we want them to be good at finding deals. We want them to be good at underwriting deals. We want them to be good at all the aspects so that they bring us deals and we can provide them capital. So we've really focused on, that's why we changed a lot of our branding here. We've changed DLP Capital Advisors, DLP Capital Partners. We changed, our DLP Real Estate Investments to DLP Real Estate Partners. So we're really focusing on partnering with other operators and leveraging, what we do well to help others and make them, more our advocate than our competition. Answer your question?
Yes.
Awesome. Thank you.
Talk to us about how you streamline efficiencies in terms of working with general contractors or GCs or subcontractors in these various states, because obviously if you're dealing in B and C markets, you're going to have properties that have asbestos abatement, lead paint, and other issues, copper plumbing. So you've got a lot of costs involved in that. How do you streamline your costs by working with either regional or national partners to bring down the cost of renovating properties?
Yeah, that's the dirty, hard part of real estate is doing the renovations and doing the construction work. So, in our early days, for a lot of years, we built it all in-house. We were, in Lehigh Valley, Pennsylvania, we had at one point 100 people in our construction company. We were a licensed plumber, electrician, GC, roofer, because it was so hard to find good local contractors. The nice thing that we've moved into these larger multifamily projects, it is a lot easier to find good quality contractors who will do, these larger projects. It's a lot of work, it's a lot of effort. So the easiest way we've done it, the best way I think I say we've done it is we took a shortcut, which is we hired great project leaders and heads who've been in this industry for a long time and have already built those relationships. So example, there's a multifamily operator called Bainbridge who owns 50,000 units. The gentleman who ran Bainbridge's redevelopment for 20 years now runs my redevelopment, as an example. We bring great people, and then we spend a lot of time networking. We go out, we go to events, we meet these different contractors. We take our time to teach them who we are and what we're looking for, and take time to get multiple people out looking at a project so we can always be vetting new people. It's a lot of work, it's a lot of effort, and then the most important thing really is project management always. So it's really the contractor's only as good as the way you manage them. I used to say when we would work with contractors who flip houses, they tend to be kind of smaller contractors. You got a problem if you pay them too soon. You got a problem if you pay them too late. You got a problem if you pay them too much, and you got a problem if you pay them too little. So it's a fine art, but it's project management. So it's definitely a challenge always. Anybody in this business will tell you otherwise is telling you a story, but it's been we've been building out a lot of those efficiencies and a lot of those systems over the last few years as we've grown. Awesome, great question.
You had mentioned a foundation at a previous dinner. Can you tell us more about that?
I did skip over that, so that is a good question. So we launched the DLP Positive Returns Foundation on January 1st. And what the foundation is we're focused on providing capital and resources to two issues. One is the epidemic of affordable housing, and two is to support entrepreneurship. So I think the second epidemic in America is the job epidemic. The jobs are not going to Mexico. The jobs are leaving due to technology. Amazon will delete about 1.5 million jobs this year alone. I have Amazon in my house every day. I'm not knocking them, but the jobs are being replaced very, very quickly. So I think the only way it's going to solve that is entrepreneurship and new jobs being created, new business being created here in the U.S. So those are what we're focused on, and how we put money into this foundation is a lot of ways. We do it through our company. We have different incentives we do as a company. As we achieve certain productivity goals, we donate money on behalf of our employees. And then the biggest way we're going to put money into this foundation is our newest fund that's not yet live, but it's going to be our newest version of those fixed notes. It's going to be called the DLP Positive Returns Fund. It'll be live any day. We charge a 1% management fee on our fund. Our returns that we show to you are net of our management fee, but we charge a 1% management fee. We're going to donate that 1% management fee to the foundation. So we're going to donate our management fee on all the money we bring in the fund. So we're going to raise $100 million into that fund over the next 2 years. So we're going to donate $1 million into that foundation, focused on those two initiatives, and a lot of other ways we're bringing money into it too. And we're already partnered with some really cool groups. A group called Good Works that specializes in helping people who already own their home, but it's in disrepair, coming in and fixing the home for them at no cost and providing them faith-based guidance, because usually they have other issues going on as well. It's a really great organization that we partnered with. So it's something we're pretty passionate about as a for-profit business. Affordable housing issue, and then as our nonprofit, it made great sense for us to put our focus and energy there. Thank you, Jen.
Thanks, Don. So first of all, I like the idea of faith-based guidance. That's good. Second, just to kind of dovetail off of what Jen said. So if you look at the people in this room, most of us are of a different generation. As the millennials kind of go into the workplace, it's more of a retail-driven environment, so they're not making as much, and even in post-college setting, it's hard for them to get jobs and meaningful income. So how do you see that fueling the types of properties and the affordability of the properties that you're providing?
Yeah, I mean that's the whole issue in a nutshell there. So right now you see these new apartment communities going up that I've been talking about $1,800 a month rents. We see management companies allowing people to put 40% of their gross income to qualify for the apartment, which is 50% of your net income. If 50% of two out of your 4 checks or 1 out of your 2 checks is going just to your rent, it doesn't work. There's not enough money to stretch. So how do people actually do it? Well, they're living on credit cards. And that's why consumer debt's at all-time highs, and student debt's at all-time highs, and consumer and student debt defaults are at all-time highs right now. And that's always the first start of the default cycles. So that is a real issue, and to think your point earlier. So that's why we think this affordable space is so important, because the jobs can only afford $800, $700 a month, $900 a month places to live. So we think when people's credit cards get maxed out, or just the confidence, when you're younger and also the market's good and everything seems great and you're moving forward, you think, oh, I'll make more money later and I'll get caught up then. When that confidence comes out of the market is when people realize, number one, usually they can't keep living off debt because the debt dries up, but also they're not willing to because they're too afraid of, because the confidence goes out of the market. So we think that when that realization comes, it's going to force a lot of people into the $800 a month apartment instead of the $1,600 a month apartment, and why we think occupancy and rents are going to stay so strong. Great question.
So you're kind of stable now, but positioned for maybe a more robust return.
Yeah, we don't model or target that it's going to be much better than it is today. We assume rents are going to go up 2% a year, and we assume expenses are going to go up 2% a year. We don't assume occupancy is going to get any better than it is today. Should it? Yes. But occupancies are great in this space. I mean, most markets, if you're managing a property well, you're at 95% occupancy. You really can't get that much better than that, really, from a practical standpoint. So really, it's not going to, you might see another, if you're running a good management company, there's not a lot you can pull up in additional occupancy, no matter how high the demand gets, but you can keep pushing up rent. So more demand means, higher rents. And still, when the spread is so big of $1,800, $800, if you're charging $1,000, that's still so much more affordable than $1,800, as an example.
Good, thank you.
Anybody else?
How much cash do you keep in reserve for opportunities? That's one question. And the second question would be with it, should we have a downturn? Isn't that a great buying opportunity?
Second question I'd like to tackle first, yes. And that's the message we hope we get across to our investors is, our big goal, from a business standpoint, from an opportunistic standpoint, we can't wait for the next recessionary environment from an opportunity standpoint. Now, I don't want it to happen because I don't want lots of people to lose their homes and all the negatives that come with it. But from a business standpoint, we're going to do very, very well when the next recessionary environment comes. The only thing that's going to really be our real challenge is going to be investors not being afraid and wanting to put their money in annuities again, like people did in 2010, and or put it under their mattress, and our investors being confident that they're going to want to actually take more of their money out of the volatile places they're in today and add more money to us so that we can go out there and buy more properties. So yes, there's going to be amazing opportunities when the market turns. As far as how much cash we keep, of investor capital, so every one of our funds has its own bank accounts and its own structure. So across our various investment accounts, which is your money, on average we'll have 5 to 10 million at any time. It fluctuates a lot. But then we have access to more cash through leverage facilities that, like right now, we have about $9 million we could draw on today from a leverage facility and have cash available, but it's not costing us anything today. So it helps us to not need to keep so much cash. That's the biggest challenge for us in generating the returns we generate is when we have cash sitting, earning nothing, and we're paying out 13% returns, it drains you. So we can't keep tons of cash sitting there. Investors like to earn returns on their cash they have with us, so it's a minor problem of cash sitting. And then as an operating company, we tend to have $5 to $8 million of our own cash in our accounts, to fund our businesses. And also, I'm often, if we don't have enough cash for certain deals, I'm often filling in and putting in more bigger pieces of deals to get deals closed. So we're always making decisions to buy properties based on the opportunity, not based on how much capital we have at that very minute. Answer your questions?
Yep.
Thank you. Anybody else? Oh, come to you next, sir. Tim.
Just a quick comment, if I could, to the, especially the gentleman's question about competition. I've been with Don for 4 years, but I like to see what else is out there. And, there are other smart people with ideas like Don, but they tend not to invest in the back office. So when I don't get a check on time or I don't get paid without prompting someone, I don't really care how good their ideas are. And something simple like tax time. They don't invest in their back office, you're not going to get your K-1, you're not going to get your 1099, and you're going to wonder where it is and have trouble with that. So with being with Don for 4 years and getting to know some of his employees, he's really got a special bunch. I think it's hard to replicate what he's invested in employees and what he really has going. The CFO isn't here tonight, but the caliber of person that he's brought in to be the CFO and make sure all that's running smoothly is just incredible. And Barry and Ken and Jim and all the other employees here I've got to know a little bit. They're really special people. It's incredible what he's built for a private enterprise.
Awesome, thank you, Tim. Thank you. Yeah, Bob is our CFO. We have 16 full-time accountants to talk to this point, to make sure you guys get paid on time. We just hired another full-time fund accountant today to handle the additional checks we're sending out to investors. But thank you, Tim.
Sure.
How are you?
So question, 11 to 12% return guaranteed is obviously difficult to find about anywhere. So what is the investors, the private investors' role? Why do you need us?
That's a good question. So first, let me preface it. We don't have 11 to 12% guaranteed returns, but we have the two funds, the Income and Growth Fund, any fund, have a target return of at least 11%, which we've succeeded in past every single month. So it's not guaranteed, but we exceed it and has a preferred return of 10 a year before we get to earn anything. But why do we need investors? The way we look at it is, first of all, we need investors because we're funding more loans, buying more properties, and need more capital, and don't want to, often question kind of the other way people ask that question is, why don't I just go get, money from a big, huge institution that'll provide me cheaper money and give us all the money we need? And we get those opportunities all the time from some of the biggest private equity names you've heard of, but it doesn't give me passion. The fact we hear all the time from investors like what Tim just said, who tell us how investing with us has changed their life. They're so much more secure in their retirement. They're able to retire. How much of an impact it's made in their life, and it's really what drives me personally. And it's really enjoyable. It's a lot of fun. Giving another $10 million to Goldman Sachs isn't as exciting. And then how we look at the returns is, number one focus is no losses. Number two is consistent returns. I'm going to generate as high as returns as I can doing those two things, and we've been fortunate that that's been 13%, 14% type returns in these funds, but that's what we're able to generate. We're not saints. We make lots of money too. We're doing very well in our strategies, but we feel it's appropriate for our investors to do very well as well, and we think that builds the confidence and trust again to that point when these huge opportunities come 2 years from now. The investors are going to stay with us and have confidence and trust in us to navigate through the next environment and work with us as we do so. That's your question? Cool, thank you. That's a good question.
Because of your business model, and you're paying 7% to on up, and we all know Bernie Madoff couldn't substantiate an 8%, so we're talking as investors saying, we're going to guarantee 7% minimum on up. But from the other side of that, from a lending perspective, and as you know, I'm a banker, what stops you, if from a business model, from going to Goldman Sachs and saying, give me $100 million at 5.5, 6%, whatever, and you're paying us 7, 8, 9, whatever, that leverages you up. Philosophy. I know what you're doing, but I'm asking from a business perspective, why wouldn't you go to the money centers, whether it's Goldman Sachs or Chase or Citicorp or whatever, they got $100 million or whatever you need at a much lower rate than you're having to pay us as investors and doing all this work with us.
Sure. So just between us friends here, Goldman Sachs has actually been trying to buy us for quite some time and fund all of our lending business. and have no interest in it. So that actual situation is real, and really didn't know that. But you know, if anybody here, my employees can certainly tell you this. I don't do well really listening to other people's direction all that well, and I know I wouldn't last very long of reporting to Goldman Sachs and reporting to them and managing money for them. So it just, you know, we're entrepreneurial, like being able to navigate, be nimble, find opportunity, and feel that it would slow us down and take the joy out of it. And you know, I make plenty of money, and you know, I'm having a lot of fun at it. So I don't really want to take the joy out of it to pick up 300 basis points or 3% that I can keep and not give to the investors by finding a big institutional investor, which they're out there right now more than ever. We get calls almost every day from some big new group. I joke about this, but it's true. In October of last year, of 17, an article came out in the Wall Street Journal that said, home flipping is back. And it was actually mainly focused around different ways private money is lending in this space. And I swear every big hedge fund in New York read that article and said, hey, maybe we should do that. And literally every big fund now is in this space trying to provide capital to guys like us. They want to buy our loans, they want to provide us leverage, they want to buy us. The amount of big capital that wants to do that is pretty crazy. Yes. Get ready.
Sorry. I mean, is it fair to say that that's a good point when it's not sexy anymore? The fund is going to dry up. If you took that other route, isn't that a fair point too, that folks like us might hang around for our returns a little bit longer, but when it's not fun at a cocktail party, it's not the sexy thing anymore for them to be in?
Exactly.
They're just going to pull a fund.
So his point being, that's another great point. The big, huge hedge funds, they'll get a mandate and they'll say, go invest $250 million into short-term fix and flip loans. And then a year from now, that mandate changes and so they say, we don't want to do that anymore. There's something better to do. And they decide, all right, we're going to pull our money out. You know, our focus is we have this philosophy of a 20-mile march that we grow every year consistently. You know, we need we're in this business long term. Being in a business where people could change their mind and we have to change our business or slow down isn't attractive to us. So, you know, we're on a path to grow forward and we want investors who are going to stay with us. But if any of you, you know, I don't say this in any negative way, but if any of you decide to take your money out, it doesn't affect us because nobody has 1% of the money we have under management. So individual people in this room can change their mind about the business and it doesn't affect the business, doesn't affect the rest of the investors. But one big investor with $50 million does change the business.
And it would be hard to rebuild this quickly.
Exactly.
If
You have to start all over again. Yep.
But,
Exactly. Any other questions? All right. Well, then I'll wrap up. I'll be around as will the rest of the DLP team members. Love to chat with you and appreciate all your time and patience tonight. Thank you.